How do some investors turn $1,000 into $10,000, while others lose everything just as fast? The answer is one powerful word: leverage. Leverage is one of the most misunderstood tools in finance. When used wisely, it can amplify your returns. When misused, it can ruin entire fortunes. In this video, we're going to break down what leverage really is, how it works across different financial areas, and most importantly, how to use it without letting it destroy you. At its core, leverage means using borrowed money or resources to increase your potential return. Think of a seesaw. One end is your money. The other end is borrowed money. With the right balance, a small push can lift a big load. That's the power of leverage. In finance, leverage allows you to control a larger asset with a smaller amount of your own capital. For example, if you invest $1,000 and borrow $4,000 more, you now control $5,000 worth of assets. That's 5x leverage. If your investment goes up by 10%, your gain isn't $100. It's $500 on your $1,000, a 50% return. Sounds amazing, right? But it cuts both ways. If the asset drops 10%, you don't lose $100. You lose $500, half your money. This is the double-edged sword of leverage. It multiplies gains, but also multiplies losses. A good analogy? Using a sharp knife, it can be incredibly useful, but if you're not careful, you could get badly hurt. This is why understanding leverage is so important. It's not just a financial strategy, it's a mindset. Leverage isn't just for Wall Street, it's everywhere. 1. Real estate. When you buy a house with a mortgage, you're using leverage. Let's say you put down $50,000 and borrow $200,000. You now own a $250,000 asset. If the value rises 10%, that's a $25,000 gain on your $50,000 investment, a 50% return. But if the housing market crashes by 10%, you lose $25,000. And if you need to sell quickly, you might end up owing more than the property is worth. Second, stock market. Margin trading. Many brokers allow investors to borrow money to buy more stocks than they could with just their cash. This is called margin trading. It increases potential profits, but also risks. If the stock rises 5%, great. But if it drops 5% and you're over-leveraged, you could face a margin call, where your broker forces you to sell at a loss. 3. Businesses. Companies use leverage to grow faster. They borrow to invest in equipment, staff, or new markets. If their investment pays off, profits grow faster. But too much debt can lead to bankruptcy. This is why many startups fail, not because their idea was bad, but because they took on more debt than they could handle. 4. Private equity and hedge funds. These firms often use massive amounts of leverage to amplify returns. They might put in $1 billion of their own money and borrow $9 billion more. If their bets go right, returns are huge. If not, the collapse can be spectacular. Remember the 2008 financial crisis? It was fueled by excessive leverage in the housing and banking sectors. When asset prices fell, the debt load became unbearable, and the system broke. Let's say you invest $1,000 in stock. If the price rises 10%, you gain $100. That's a 10% return. Now, let's say you borrow another $1,000 and invest $2,000 total. If it rises 10%, you gain $200. But your original money was $1,000, so your return is 20%. That's 2x leverage. But if the stock drops 10%, you lose $200. That's a 20% loss on your money. At 5x leverage, A 20% drop in the asset can wipe out all your capital. That's why brokers force margin calls. They sell your assets automatically if losses pile up. Let's take a more extreme example. If you're leveraged 10 to 1, a mere 10% drop in value wipes out 100% of your investment. Leverage makes small changes in price very powerful, which is great until it isn't. This is why seasoned investors always look at risk-adjusted return, not just total return. Used correctly, leverage can be a smart tool, but only when certain conditions are met. 1. Predictable cash flow. If you can reliably cover debt payments, like rent from a property, leverage can accelerate wealth. But if your tenant moves out or doesn't pay, your cash flow disappears while your debt remains. 2. Low interest rates. If you can borrow at 4% and earn 8%, you keep the spread. But what if interest rates go up? Suddenly, your spread shrinks or disappears entirely. 3. Strong risk management. Professionals hedge their leveraged positions. They plan exits. They don't guess. Tools like stop-loss orders, option hedges, and diversification are essential. 4. Emotional control. Leverage tempts people to bet big. But one emotional decision can undo years of gains. Never invest more than you can afford to lose, especially with borrowed funds. It's not about whether leverage is good or bad. It's about whether you understand the risk and respect it. One of the biggest traps with leverage isn't the math, it's the mindset. People often believe they can outsmart the market. They assume the same trend will continue, and they load up on borrowed money to chase quick gains. This overconfidence can be deadly. The more successful a leveraged position becomes, the more tempting it is to increase the risk. Until one day, the market moves the other way and wipes it all out. That's why professionals always say, respect the leverage. It doesn't forgive mistakes. Leverage is a financial power tool. In skilled hands, it builds wealth. In careless hands, it causes disaster. Ask yourself this: are you using leverage, or is it using you? The world's most successful investors, people like Warren Buffett, understand the power of leverage, but they use it sparingly. Even Buffett has warned, it's insane to risk what you have and need for what you don't have and don't need. If this video helped demystify leverage, hit like, subscribe, and share it with someone who's about to invest with borrowed money. And in the comments, tell us, have you ever used leverage in your life? Was it a win or a warning? This is Finance in 10. Complex finance made simple, in just 10 minutes.